So welcome delegates, welcome to the seminar, Application of Strategic Sourcing for
Thank you so much. Thank you.
SCM, Supply Chain Management. I will take around 3 to 4 minutes time to introduce this organization and couple of upcoming programs in the areas of supply chain management. And after that, I will hand over to our resource person, Mr. Abdullah Al-Masood. He will continue for the next 1 hour on this particular topic. Let me share my screen. So this is World Academy for Research and Development. We are a UK-based certification and professional education organization. We are ISO certified organization as well. We have some global affiliation. We are offering programs in 57 countries. We are approved center by Cambridge Academy of Professionals and approved center by 𝒄𝒂𝒕𝒊𝒄 UK. Provider of HRCI, SHRM, and TD, both all are in US-based HR certification bodies, and accredited institute by International Professional Accreditation Council, which is a Singapore-based organization, and we are SHRM academically aligned institute. We are also the member for CPD Certification Service, which is an UK-based certification awarding body, and we are partner of Singapore Training and Development Association. These are our global affiliation for World Academy. Our upcoming supply chain related courses, we have a couple of courses in the areas of supply chain. One is Diploma in Logistics and Supply Chain Management, which is a 6 months long course. And we are offering 50% off for this batch starting from 21st January. There are around 32 classes in 6 months time. Every Sunday, the class time. And another is Certified Supply Chain Management Program. That is a professional credential in the areas of supply chain. So this course having 10 sessions, each session on 2 hours. So total 4 months duration, and starting from Sunday, 1st of February. 11th of February. Apology. So 11th of February, the starting date, and the class timing is every Sunday 8 to 10 p.m. Bangladesh time, or 2 to 4 p.m. GMT, the global timing. That is another very holistic course in the areas of supply chain management. And another one is postgraduate diploma in supply chain management, PGDL SCM. The qualification required for attending this course is graduation or the bachelor degree. You need to become bachelor. You need to have a bachelor degree to enroll for this course. This course will be starting from 9th of March. So anyone can enroll for that as well if you are interested. Some other courses in the areas of other parts, like in HR, there is a professional certificate course in HR operation. In learning and development, there is certified learning and development professional. We told about this logistic and supply chain management, then postgraduate diploma in project management, then certified organization development professional, CODP, starting from 21st, certified project finance analyst, which will be starting from the project finance analyst from 27th of January. So these are the couple of programs, upcoming programs, which will be commencing very recent time. And majority of our courses are accredited by Cambridge Academy of Professionals, and our diploma and postgraduate diploma programs are accredited by 𝒄𝒂𝒕𝒊𝒄 UK. So there is a very globally recognized certification from World Academy, and our expert resources from different countries. And for supply chain programs, our one of the very prominent resource, Mr. Abdullah Al-Masood, he will be talking on this particular topic today. So I will not take much time. Thank you for joining us, and I'm handing over to Mr. Abdullah Al-Masood. Sir, please proceed.
Thank you, 𝑭𝑺𝒆𝒎𝒊𝒏𝒂𝒓. It was wonderful having you and your brief. It was wonderful for having such a brief on the organizations. Thank you very much. And thank you all for joining. Welcome all. It's good to see you guys. So we are ready to go, right? Yes?
Yes.
Okay. Okay, good. Okay, so we start, right? So today's session is all about application of strategic sourcing for cost-effective management, cost-effective supply chain management. So while we are talking about supply chain management and we are talking specially about cost-effective supply chain management, strategic sourcing is one of the core area where we have value additions, right? You might have known strategic sourcing, procurement. There may be some confusion. So let's talk about it. So we will get find what really strategic sourcing is, how it making or adding value to the organizations, how it is making a change in the organization, and it is contributing to the supply chain management. So today's learning session, what we'll be learning in this session, let's talk. Okay, and just for your understanding, so if you feel like you do have a question, please don't hesitate to quickly note it. So it's okay, you don't need to make a text, you just unmute and straightway put the questions to the session. It's okay, and I will be answering that. Okay, yeah, it's okay. That just let me know whether you are listening me. I'm audible, visible, everyone is listening to me. Yes, no, what? I need a quick voice from you guys. Yeah. Hands
Yes,
raised.
yes, sir.
Okay, great. Excellent. Hand raise. Hand raise. Someone raised hand. Okay, it was a mistake, I believe. Okay, fine. So we continue. So the learning session of today is sourcing strategy. Number one. Number two, the business benefit of sourcing strategy. And estimating cost and price. We'll get to learn what is price, what is cost, and how to estimate that. Budgetary control and cost efficiency. Then we have with us the leveraging organization's cash flow for cost efficiency. So these are the things we'll be covering. So sourcing strategy, what is sourcing? What is the strategy? Business benefit of sourcing strategy, estimating cost and price, budgetary control for cost efficiency, and leveraging organizational cash flow for cost efficiency, right? Okay, so in the very beginning, sourcing strategy. While we are talking about sourcing strategy, we are always very much in a dilemma. What is really sourcing is, what are the things it is addressing? So let's see. So sourcing strategy specially describe material and services and vendor categories, right? What we procure material, we procure services. So sourcing strategy specially describe material and services and vendor category. That means the vendor we manage, their category, vendor category, and list the preferred vendors, right? That means in sourcing strategy, we are specifically focusing on what? On material and services and the vendor management, right? So it is also a set of objectives that creates ecosystem consolidation of synergies and mitigation of vendor lock-in situations. So the three catch points are here: creating creative ecosystem, consolidation of synergies, and mitigating vendor lock-in system. So what is it creating? What is ecosystem? Creating creative ecosystem. What is the ecosystem? Anyone would like to participate? What do you understand a creative ecosystem is? Anyone? Anyone would like to contribute? Yes, no. Hi, Sam. I'm waiting. No one. You know what is the ecosystem is, please. But yeah, please. Thank you. Thank you for raising hand. Okay, please tell us. Yes.
Yeah, for ecosystem in a scientific point of view, it's a system. It's a system wherein the environment and organism interact.
Right. That means the interdependency within the system, right? When there is a system, there is an interdependency. So while we are talking about supply chain or sourcing, we do have some interdependencies in a system. So a creative ecosystem, that means in such a creative way, the ecosystem is developed so that we have an efficient handover and takeover within the system, right? And consolidation of synergies. What I talk about synergy, we know what synergy is. While we are talking about, we know synergy, right? Yes, no? Synergy? Okay, fine. Anyone? Fernandez, would you like to contribute? Okay. Synergy. Anyone? Synergy? Consolidation of synergy?
Can I try?
Yeah, please do. Please do. Fode.
Yeah, I think synergies are when two or more organizations are either doing the same kind of job or work come together to combine and do the work together.
Very good. In a sense, you're right. So, in a very nutshell, while we're talking about synergy, we can say that 2 plus 2, in generally, it is 4. But while we are talking about synergy, it is 2 plus 2 is making a total of 5, right? Right? That means something more than it generally used to be. So, while we are talking about sourcing strategy, it is creating a creative ecosystem, consolidation synergy. That means it is creating a synergy, and mitigation in vendor lock-in situation. In many of the negotiation, we'll get to find that we are locked in a vendor with a vendor because we don't have any option to move out, and we are bound to get into that thing. So if we had a strategic sourcing and planned well ahead of time, we will never be in a vendor lock-in system. So these are the 3 focus area or 3 catches that we need to understand, right? So what are the key objectives of sourcing strategy? Are the key objectives: the identify the material and services category, define the primary service strategy to provide service internally, and source from sole, single, or multiple vendor, right? So we can source the material from sole vendor. What is a sole vendor? There is no other vendor. There's the single options. Or, sorry, there's a sole options. There is a monopolistic scenario. Or we can choose a single vendor to be a single supplier to be our vendor, or it can be a multiple vendor. That means we can go for multiple vendor. Build innovative and competitive ecosystem to create business value, to generate business value. So we have to create a competitive ecosystem. That means a smart handover takeover within the process, and maintain a good negotiation position so that we don't get into a vendor lock-in scenario, right? So we can avoid that. So let's see, when setting the sourcing strategy, it is essential to consider. What is essential to consider? That we need to, excuse me, consider business drivers to identify what the company wants to achieve, and such like low cost, fast time to market, extensivity or innovation. So we really need to have back in our mind what we are looking for. We are planning to have a sourcing strategy to ensure what we need to consider. We need to consider what is our core goal that we are looking for. We need a cheap product, low cost product, or we need to be very small, very fast to the market. Fast to the market can be in 2 of the places, like launching a product, you are in a pioneer scenario, that is fast to the market, or in every delivery you are very fast than your competitor, like pizza delivery. It is a competition whether you can win from your competitor, right? In many of the countries, it's already there that 30 minutes pizza delivery, either it is on time or you get it free, kind of things, right? Yes, no? Yes? Is it not? Do we have these options? Yes, no? No. Yeah. Okay. Okay. I guess so. Okay. Are you getting me? Yes, no? Are you guys with me? I'm okay.
Yes, yes, sir.
Okay, great. I'm going fast. I'm going slow. I'm making sense. Let me know. Just a quick chat. Yes, no, what? Everyone, okay? Okay? Okay. So, great. So, the next point is market dynamics, to define how many suppliers are available, why the suppliers want to engage with you, what are if there are any regulatory issues that is creating a hindrance or that is supporting the business, rising or declining ecosystem. So 2 of the things we need to consider. One is the business driver, and other one is the market dynamics. In the business driver, we have already spoken that what the company wants. That means if they are looking for a low cost, is they are looking for a fast to the market, or extensively and innovations, high level guiding principles. What are the things they are looking for? And in the market dynamics, we are looking for how many suppliers. That means our market scenario, how many suppliers are there, how many competitors are there, why the supplier want to get engaged with us. That means we are we purchase in a volume. So that is one of the interest area for the supplier to get engaged with us, or we are one of the reputed organizations as a buyer. So the supplier want to be one of the partner, right? So this can be the thing. So we need to identify, and any regulatory issues rising or declining ecosystem, those are the things we need to understand, right? Guys, is that okay? Understood? Yes, no? Understood, right? Yes, no? Just tell me yes, no, and you don't need to write. Just tell me yes, no, unmuting the thing in a voice so that I can feel like I'm not
Yes.
left out.
Yes, sir. Yes, sir.
Great, excellent. See, when you speak, what it feel like? We are in a conversation. When you just keep quiet, then I feel like I'm left alone. I'm speaking to no one, right? Okay, thank you. Thank you for responding. So, business benefit of sourcing strategy. What are the business benefit for sourcing strategy? So let's go by the points. Like here it is said that fulfillment of a specific business objective. So what are the business benefit of sourcing? Fulfillment of a specific business objective, increase revenue, that's one of the core. Reduce cost, this is also a very important target that's always been. Enhance profitability, ensure value for money. So whatever we are buying, we need to ensure that value for money. What is the value for money? Value for money stands for anything you buy for and the payment that you're paying for, it worth the value, right? That means you have been asked to buy and you have been asked to buy an iPhone for one of your director, maybe for the organizations, and it is a value for, let's suppose the value for the iPhone, the model that's been spoken for is $5,000, for example, just a rough cut example. So you decided, okay, no, it's very expensive, so let me buy some other brands so that it will be a lower price. So it doesn't make value for money. Value for money means you have purchased that phone, the specific model or that specific brand, what have been asked for, but you paid the price which is most competitive in the market. That means you have bought it in a very competitive mode and maybe better than any other, if not at least not at a higher price than others, right? Okay. Enhance shareholder value, that's another thing. Competitive advantage, leverage of key resources, increase capacity, capability, or flexibility, and improve brand or reputation quality. So these are the business benefit. Links between corporate and sourcing objectives. See, while we are talking about strategic sourcing, that means it is linked with the strategy. That means it's a strategic part, not an operational part. So when we are talking about strategy, it is always in line with the business objective, right? So in line with the business objective, right? So it is in a corporate strategic thing, right? So what the business is looking for and how sourcing is aligned with that. So business, what is our business objective and how sourcing activities or sourcing objective is aligned with that, right? So let's say while the business objective is maintaining or increasing market share, while the business objective is maintaining or increasing market share, then the sourcing objective will be providing suppliers to match customer need, assure quality, reduce delivery lead time, and reduce cost. Why it is? So in the business objective, we have decided to increase the market share. That means we need to increase the number of customers. We want to occupy the competitors share as well, or we want to capture some of the competitors share. So how we do that? In sourcing, how we can do that? We can do it by providing suppliers to match customers' need. That means we have to be very focused what our customers are requiring for. Assure quality. So we cannot deteriorate our quality so that our customers are moving out. We cannot ensure delay in delivery, right? So in lead time, that means if we do not procure on time, we cannot produce on time. If we cannot produce on time, we cannot deliver on time, right? And we have to ensure reduce cost. That means if you can reduce cost of the raw materials or the ingredients of the product, what you can do, you can ensure better profitability or better price for the customer. Whenever you are competitive in price, you can capture the market share, right? Understandable? Are you getting it? Yes, no, what? I guess so.
Yes, sir.
Good, great. So the same
Yes,
way,
sir. Yes, sir.
great, excellent. Thank you for responding. This is a good one. Great. So when the business objective is improve profit, cash flow, and return on capital, then in line, the sourcing objective will be reducing stocks, improve reliability, and more frequent delivery. What is reducing stocks? That means we want to improve profit. If you want to improve profit, you want to ensure that your cash are not locked in. If you do not want to lock your finance, that means you are reducing your stocks or inventory. If your inventory is less, then your cash flow is more in a better scenario, right? You can improve your reliability and more frequent deliveries can be done. While your business objective is short time to market, that means launching new product in a market in a very shorter pace of time, or delivering in a faster mode, then your in line your sourcing objective is early supplier involvement. If it is a if it is a launching a new product in a very faster mode, in a very faster mode, that means faster than your competitor, then you have to engage your supplier in the early stage. What really happened? Our R&D works on, then our marketing get into the thing, they together plan, and then they decide what they do. Then the production come in, they decide what kind of material will be used. Then it comes to the sourcing guys for sourcing the raw materials. When the sourcing guys started sourcing the raw materials, they can find it is very expensive. The product or the material that has been chosen chosen for the raw materials or for the components are not a very common one, or it is very hard to source. To this kind of things come in. So it is very convenient if you want to go if you want to be in the market in a pioneer or in a shorter a shorter time to market, then you have to engage your suppliers in the very prior hand, right? Okay, so that's another thing. Please, can we have the recorded video to be rewatched? I guess so you can have it. So after the session, you can speak to the ward authority. They will be letting you know. Okay, fine. So we move on. Business objective. When the business objective is eliminating non-core activity, that means you are very focused, or our organization is very focused on core activity or value-adding activity or the main activity, then our sourcing objective will be developing effective make or buy policy. Make or buy policy means either we make the product or we buy it from a third-party source, or we outsource the thing. Okay, integrate purchasing and capacity planning. While the business objective is introduce continuous improvement, then in line our sourcing objective will be reduce supplier base, partnership approaches, reduce product complexity, increase accuracy and reliability. When our business objective is becoming world-class supplier, then our sourcing objective will be work with the suppliers to establish world-class standard. In line, we have to ensure our suppliers are standard enough so that they do not deteriorate the quality, and improve flexibility to respond to the market condition, and liaison with the excuse me liaison with the technological sources. To be the world class, you have to always be in a pioneer in technology. So we have to liaison with the technological sources. So this is what the business objective, and in line the sourcing objective will be. Are you getting me? Getting the things? Is it?
Yes, sir. Yes, sir. Yes, sir. Yes, sir.
Great, excellent, very good. So we move on. Fantastic, great. Okay, the lease or buy distance. Say we have spoken a bit earlier. We can do a make or buy decision. What is a make or buy decision? Suppose we have a manufacturing plant and we have a capacity constraint. So while there is a additional demand in the market, either we can add on new machineries and have an extension of the production line that we can do, and we can make the product in addition, or we can buy it from a outsource from a third-party suppliers who is also having a production plant and having a additional capacity which is not being used. Right or wrong? Yes, no, right? Yes. Fine.
Yes.
That's one scenario. The other scenario is, while we are buying, we may buy a thing or we can lease a thing. Just take an example. For example, you have let's take an example. We have an office. We are very new in the business, right? And now we have already taken one of the office. Excuse me, just a minute. I need to take this call somehow. Just a minute, please. Okay. Sorry for the interruption. It was a very important call to take. So, suppose we are very new to the business. We just started the business and we have taken an office, rental office. And at this moment, we have found that there is a severe electricity fluctuation, or electricity fluctuation, which is interrupting our regular business work. So in that case, we have decided that we need a generator as a backup, right? And here we need a what I will say, heavy duty generator. It is a very expensive one. It is a very high capacity generator. For example, 20 kVA generator, or sort of something like that, 50 kVA generator, something like that. So in that case, we have decided that if we buy this generator at this moment, our financial fund will be locked. And being a new business, we really need cash in hand for a working capital. So it won't be a good decision to do that. In those cases, we may lease or rent the generator from a generator company who gives a rental basis, right? It happens, right or wrong? Yes, no, right?
Right.
So this kind of things
Yes,
happen.
sir.
In those cases, we really need to judge whether it is a good decision to rent a product or lease a product, or it's a buy the product. So there are several advantage and disadvantage of purchase upfront, that means direct purchase, or there are also also some advantage and disadvantage of leasing. So we will be always comparing before we make the decision. So let's see what are those. In case of outright purchase, the advantages are the total cost is low compared to rental. If you take a rent, the total cost of purchase will be lower than the rent. Obviously, because anyone is giving you a rent, they will try to extract. I mean, they will try to ensure the entire purchase value being what I will say, reimbursed from you, right? So the cost is low compared to rental. The user has the total control over the use of the asset. Since the asset is mine, I have already purchased. I can have the entire control of this. No one is going to have an interference on that, right? The asset may have residual resale value. When the end of life of the product after 10 years, I can sell the product at a book value or at a salvage value, right? The capital allowance maybe maybe set against tax and government grants and may be available. So we have tax, we do have a capex. In those cases, we can do some depreciation activities. So these kind of things are in an advantageous scenario while we are doing an upfront purchase or outright purchase. But there are some disadvantage while we are purchasing a high value item. High initial expenditure ties up as a capital, right? While we are purchasing a capital thing, so high value expenditures are locked in. User bear all the cost of risk of maintenance and operation on disposal, right? So since I have purchased the entire thing, so any maintenance, any spare parts required, anything required in the operational or disposal, all the things need to be bear by the buyer. Risk of technological obsolescence. We have purchased a product and suddenly we can see there is a technological upgradation and new product come in which are more efficient and very less operating and making a very lower operating expense. So in those cases, disposing capex, which is not in its end of life or in mid of its life, it will not be a worthy one, right? and wasteful if the equipment is needed for a very short period. We are in a rental office, and we know that our main office, our own office, are in a construction scenario, and it will be completed within a month, within a year. So in those cases, for 1 year, it is not a good decision to buy a huge capex just for a maintenance, just for a office, what I will say, for this kind of thing, right? So advantage of leasing and disadvantage of leasing. So let's see the other way on. So while we are talking about leasing, what are the advantage of leasing? No initial investment or tie up in capital. The capital is not tie up. Protect against technological obsolescence. So if the technology changes, we will talk to the supplier to change the product or upgrade the product. Costs are known and agreed in advance. So we do have a agreement and write in a writing that how much we will be paying in per month. So that fixed the cost is very fixed, right? Few complex tax and depreciation calculations. So there are very simple calculation, because this is a totally OPEX. The previous one is a CAPEX, capital expenditure, and this is the operating expenditure. So this is very easy to calculate. Hedge against inflation, as payments are made in a real money terms. So we can have an hedge in a inflation. That means any inflation comes in or anything that that cannot affect us, because we have a fixed terms with the supplier. Disadvantage of leasing: long-term commitment to pay installment. So it is a longer time we have to be at the installment, and it's a ongoing process. User does not have full control on the asset. Obviously, the total cost may be higher than the purchase. Of course, the total cost will be higher than the purchase if the product's life is 10 years and you have decided to buy the product for 5 years. They are certainly going to charge you more than the 5 years value of the product, right? Large organizations may get better terms by securing their own finance to purchase. So if we are a very what I will say, cash incentive organization, we don't have any shortfall of cash, we have abundant cash, so it is not good to go for a leasing. Contract terms may favor the lessor. Example: limits to use, liability to risk and cost. So the lessor, that means who is leasing the product, can have a advantageous scenario here. So these are the disadvantage of leasing, right? So we have seen the advantage and disadvantage of outright purchase, advantage and disadvantage of leasing. So that's the thing we can that's the thing which can help us to decide which way to move, right? Understand? You got it?
Yes, sir.
Okay, fine, great. So we really need to understand the supplier-based relationship as well. The effect of supplier-based reduction. See, we have two pyramids. One is a straight way on, the other one is a inverse one, right? So let's see, in the first pyramid, we can see, yes, any text. Yeah, we got a yeah, no, yes, no in the text. Okay. So in the first one is a pre-deduction. What is a pre-deduction and post-deduction? I will let you know later on. We have subjective cost, objective cost. Here it is a type of cost. And we have separated the cost into strategic, managerial, and operational costs. So let's first understand, while managing our suppliers, what are the costs we have? We have basic suppliers like stationery suppliers. We have our computer accessory suppliers like the tea, coffee, and other pantry items suppliers, like the basic item suppliers, which are office maintenance, and these kind of items are known as ORM, that means operational resource management items. And we do have participant enable closed captioning. Okay, so we do have multiple suppliers in this category. That means, suppose in generally what is the operational cost? Operational cost means dealing with regular operation, making a purchase order, making order, expediting order, deferring order, So this kind of communication, making query to the suppliers. So this kind of communications and collaborations with the suppliers are our regular operational cost. What is the managerial cost? In many of the cases, for vendor lock-in system, for some negotiation issues, for some difficulty patch-up system, for patching up some difficulties within the suppliers and the buyers, or some contractual disagreement kind of things, or some audit and visit thing, we need to have managerial cost. That means to managing suppliers, we need to make some cost. This is the managerial cost, and strategic costs are the top level cost. That means in a longer term, how we will be doing business with this with these suppliers, how to develop these suppliers to a efficient manner. So these are the strategic costs. So what really happens when we have in our organization 3,000 suppliers to handle, we will be very much busy in operational costs, right or wrong? Yes, no? That means making purchase order, having a query of how what is the price, putting a RFQ, request for quotation towards the supplier, calling for calling to expedite the delivery, calling to defer the delivery. So this kind of operational issues will be in a maximum areas because we have a number of suppliers, right? So in those cases, we will be very much engaged in operational costs, right or wrong? Yes, no? Agreed? Disagreed?
Yes, sir. Yes, sir.
So whenever we have 3,000 suppliers, which is a big number, we will be very much engaged in operational costs. That means we will be spending most of our time in this area. Then the mid area, auditing vendor, visiting vendor, managing critical issues with the vendor, any agreemental dispute resolution with the vendor. This kind of managerial cost or managerial activity will be a bit lower than the thing. So it will be, and the strategic area, that means having a long-term relationship with the supplier, developing the supplier, having coordination for innovation kind of things. This kind of strategic cost will be in a very small scale because we cannot spend much time here because we are more engaged in this category. So then this is pre-reduction. That means we have a huge number of suppliers which are not really necessary. So if we close down the suppliers in a very smaller area, that means if we just shortlist the supplier, that means in the we have several areas, right? Some of this, yeah, there is a question. Yep, good to know that someone raised hand. Please, Samsung, tell me your question. Yes. Yes.
Well, I'm William from Angola,
Okay.
and yeah, it's a very interesting those topics like supplier-based relationships. When I'm trying to go deep with the lesson of supplier-based relationships, so it takes me to the level of global sourcing.
Yeah.
So and when I'm running a company, that they are looking abroad to manufacturers or purchase goods and services out of Africa. So and most of our goods come from India. They are from Saudi Arabia. So now my question is, what are the advantages of global sourcing? Because we talk about supplier-based relationships. Sometimes we have more. We have a numbers of suppliers. And another question is what are the other issues? What are the other issues that can rise with a global sourcing? Because sometimes we order stocks out of countries, and it takes times for us to receive goods. So, and I end up now to take this to make these kind of questions. What are the issues that can rise with a global sourcing? Okay. Thank you so much.
Welcome. So I will take your question. Let me think whether it's a good time to answer your question first or complete this one. Okay, let's take your question first. So as you have asked that you have global suppliers like from India and from what are the other countries? Saudi Arabia, right?
From Saudi Arabia.
So see, what is your product? Would you like to share? If it is okay, would you share with us what is your product and what kind of thing you're purchasing from these two countries?
Well, we normally order those products like rice.
Okay, rice. Okay, that
And
means
from Saudi Arabia, we are ordering those product like cereal.
cereals, right? Okay, great, excellent. I understand. So, see, there is another somehow that is not covered here. By the way, by the way, you can go and see this thing in one of my. I do have a YouTube channel where I put on some of the short things as a video where you will get to find Kraljic model. It's one of the model I have discussed. Your things falls into the Kraljic model, right? This Kraljic models, I will write the what I will say my channel name, so you will get to find there. It is CPP, what is supply chain and view convo, right? So this is a YouTube channel where I used to make short videos on various supply chain issues. So there, in one of the video, you will get to find a Kraljic model. What is a Kraljic model? Let me tell you. Kraljic model decide the four quadrant thing. That means in the x-axis and in the y-axis. In the x-axis, it has importance of items, and in the y-axis, it talk about um, risk of supply. So we have to decide if the importance of item high and low, risk of supply high and low. In those two category, in those two periphery, we have within a combination of these four, we have this four quadrants. So if the risk of availability or risk of supply is very high and the importance of item is very high, this item is known as strategic item. So I can understand the item, the product you are talking like rice and cereal, these are your strategic item, right or wrong? Yes, no. This is not your
That's right.
regular item. So this kind of item has to be sourced from a very authentic sources. That means you really need to have partnering with this organization. You can choose a single or dual source or a parallel sourcing. It's a parallel sourcing is it's a different kind of thing. I will let you know later on. You can go for a single sourcing. Generally, you can go for single or dual or multiple source, but you need to make several backup for that because this is an item where the risk of supply is very high because you're buying from a global sources and the importance of the item is very high. That means this is one of your core items that you sell and you make revenue out of it. So I can see that it is one of your high traded if your organization may be a trading organization, I can understand. So these are highly traded items. That means one of your biggest, maybe your cash cow, maybe your star product. I don't know. You know it better. So these are your core items. So these core items are the strategic item, and strategic item should be taken care of in a very extensive manner. You have to have a close monitoring over there. What the international scenario is. If you see, for my case, when I used to work for manufacturing organizations for one of the flour mill and one of the rice mill, rice mill was pretty okay because in our country, rice is the staple food and paddy is well grown in our country. So there is no scarcity. So for rice mill in our country, it is not a strategic item. It is a leverage item. That means
That's right. Yes.
risk of the supply is very low, but
Mm.
but importance of the item is very high. So as a raw material, this is a leverage item. And for the flour mill, what I will say, the wheat. The wheat used to be imported from Russia and Ukraine. Those are the main area. Other than we had We had Australia, we had Canada, and other countries as well. But the main is Black Sea, that means Russia. So that is our strategic item, because we have to always look into what is the price going on, whether the price is dropping, whether the price is getting high. And the Russia-Ukraine war started, it was a crisis for us. So this is a strategic item. So you need to find this, whether it's a leverage item, whether it's a strategic item, whether it's a regular item, the other category is a regular item, or it's a bottleneck item. So these are the 4 categories. You have to first align your suppliers in those 4 categories. Then you have to decide how to deal with these things. So I suggest you go to the supply chain convo, the video that I have uploaded in Supply Chain Convo. It's a YouTube channel, and you get to find the thing. I believe that's going to help you guys, right? Okay. Did that answer your thing?
Thank you so much.
Fine, good. Thank you for asking, even though it's not within the scenario. Okay, let's come again. So we were talking that while managing suppliers, we really have 3 kind of costs: the operational cost, the managerial cost, the strategic cost. Strategic cost means developing supplier, having a relationship with the supplier, looking for long-term relationship. These are the things. That means the more you can give effort here, the better result you will get. Savings in the high value item will give 1% savings in the high value item will be more 1,000 times better than 10% savings in a low category item or low value item. You will get to find, because in a organizations you will get to find the 80-20 rule. That means 80% of the spendings are done by the 20% high value suppliers. So these kind of things, right? So more we can spend here. So if we just reduce our supplier base, then we will be getting more time in strategic cost, and even better time for managerial cost, and we can spend lower time in here, because we don't have a lot of suppliers here. We can put purchase order directly under agreements that's been done with a small number of suppliers. So under the agreement, they are regularly given repeated orders, so there are lesser efforts given here. We can give more efforts in managing things and best efforts in strategic cost, so that we can add value. So this is pre-direction and after post-direction. That means whenever we have a good number of suppliers, okay, whenever we have a good number of suppliers, we can always we will be it will be very difficult to manage the objective cost will be very high and subjective cost will be low. Or sorry, the subjective cost, that means in the subjective category, that means if we talk about strategic cost, in the strategic cost, you will not get to find the cost in a very clear eyes, like developing suppliers. There are a lot of costs associated. You have to give a manpower, you have to engage a lot of time, but you can't find those costs. But in the objective cost, you can always see that making purchase order. So I prepared 10 purchase order in a day, or 50 purchase order in a day. So my man hours can be divided into 50. Then I can calculate this. So this is why it's objective and subjective cost. So we can spend more time here and we can add value to the organization, right? Understand? Yes, yes, no. Got it. Hello, guys. Yes, no.
Yes, sir. Yes, sir.
Got it.
Okay, fine. So see, whenever we take in a project in the supply sourcing or supply chain, we really need to have a cost benefit analysis to understand whether it is worthwhile to take the cost, right? So let's see one of the cost benefit analysis specimen. So here we have seen, we have taken a project and taken the cost benefit analysis. So let's see what are the costs. Here the cost is in a pound, and it is said that computer requirements, that means our supply chain or our procurement or our sourcing department decided to go for automation from a manual based work, right? So for going for automation, what are the costs we need to incur and what the benefit we will be getting in a return? So that is what we are seeing. So here if we see the cost as a pound, so here the computer equipments like 8 PC we need 1,000 pound each, so 8,000 is the cost. One server we need is 1,200 pound, so that it is 1,200 pound. Two printers needed 400 pound each, so it's 800. Installation and technical supports, it requires 1,800. Purchase management software, it requires 3,200 pounds. So this is hardware cost. After that, we need to make staff's training for using this software. So introductory computing, that means 6 people, 200 each. So 12 pound, 1200 pound cost of training is required. Purchase management system, we need to buy a software system which is 8 people with 400 licensing charge. So it is 3200 pound. Other costs like lost time, that means when these people are engaged here in training and other development, so they are not working their regular things. So calculating their man-hour and head count, so they have already found that the lost time is 20% day, that is at 100 pound per day. So 2000 per day is a loss. So the total cost is 26,400 pound. That means we have already calculated the cost. Let's see the benefit out of it. Then we will get to find whether this project is generating benefit or is a generating cost only. So the benefit estimated per year: improve efficiency of ordering and expanding, that is 20,000. So like what are the things they have doing? Improving supplier selection and management, improving planning and control through supplier information. So these are the things we can decide. So it is improving by 20,000. It is kind of subjective cost, you can say as well. So the improving supplier selection and management, we have man-hour and other costs. For calculating those, we have found that here we can get a benefit of 10,000. Improving planning and control through supply information. So we have a supplier list. We know these suppliers, who is the best supplier, who is not a good supplier, who is a faulty defaulter supplier. So these are the things help us to have a better vision how we can proceed next, which supplier to choose. So this is how we have estimated a cost of 15,000. The total cost per year is 45,000. So the total cost is 26,000 and total benefit we have found is 45,000. So the benefit cost ratio is 45,000 divided by 26,000. We can already find that 1.7 is the benefit ratio. That means if it is more than 1, it is a positive ratio. And payback time, that means within how many days it will be paid back, the cost will be recovered. The payback time is 26,400, the cost divided by our benefit. So it is 0.959 years, that is approximately 7 months. Within 7 months, we can adjust this cost or we can recover this cost. So this is a benefit generating project and we can go for this. This is how we can always make a cost benefit analysis while we are taking new projects or anything special, right? Yes? Yes? No? What? Okay.
Yes, sir. Okay.
Good that you're answering. But what about others? Is that okay for all? Yes, no? I guess so, yeah? Okay, fine. Okay, so estimating cost and price, the interesting part. While we are talking about estimating cost and price, we really need to know what is the cost and what is the price. So what is the cost and what is the price? Price is what the seller charge, cost is what the buyer organization pays. That means cost means while we are buying the thing, it is a cost for us. While someone is selling it, it is a price, right? So let's see the primary source of market data and cost and price. So from where we get the cost and price? In the primary source, there is a primary source, there is a secondary source. The primary source is communicating with the suppliers. We get to know the price or cost, the buyer's database or market data through which we find the price or cost. Market communication of suppliers, online market exchange, auctions, sales forum, auction sites and forums, advisory and information service, trade fair, exhibition and conference, informational network, informal network and information exchange. And secondary sources are finance and trade, publish economic indices, publish online market analysis, public statistic survey, and publish listing and price comparison website. So there are some factors in supplier pricing decision. There are some external factors, there are some internal factor for pricing decision. So what are the external factors? External factors are price charged by the competitor, extent of the competition of market structure, the nature of competition in the market condition, consumer perceptions of value, price elasticity of demand, what a particular customer is ready to pay, environmental factor affecting the cost of raw material, environmental factor affecting the demand and affordability. What are the internal factor for suppliers price and pricing decision? Cost of products and sales, how badly the supplier need the business, risk management, how attractive and particular the customer is, financial position and product portfolio, where the product is in the life cycle, shareholders expectations and managerial objectives, the strategic objective of an organization. So these are the things. So we will go very quickly some cost-based supplier pricing strategies. So while we are talking about pricing strategy, see, it can be cost-based pricing. Cost-based pricing means there are three categories in cost-based pricing: full cost pricing, cost plus markup, and marginal pricing. So what is the full cost pricing? Full cost pricing means total cost plus markup. For example, I have walked into a hospital. In the hospital, they have already analyzed me. They have already spent they are calculating what is the spends of the room that I'm what are the OT cost, that is operational theater cost, what are the medicine cost, all the costs been calculated, then they are adding a profit with it. So this is a full cost pricing. That means they're recovering their cost first, then adding a profit or markup. So this is full cost pricing. What is the cost plus markup pricing? The other one is a cost plus markup pricing. In manufacturing plant, what we do, we have our direct cost plus variable cost. That means direct plus markup plus cost. So this is our cost plus markup pricing. That means we have our cost, then we have our markup. That means we have our direct cost, variable, indirect cost, then we have our markup. Then it has been that means not a manufacturing firm. It can be like construction firm, right? It's already there. For example, direct cost plus markup to cover the both indirect and cost overhead and plus profit. Useful items for too difficult to calculate over example construction firm. For example, in a construction firm, what they do, they're making a building for you, right? What they do, they take the direct cost, they take the indirect cost, and they add on the markup. So this is how the cost plus markup pricing is developed. Marginal pricing or predetermined pricing. That means you are importing something from the international arena or from your international supplier that has been already set, and you have already decided I will be making a 10% profit on it. So this is a marginal pricing or predetermined profit margin. That means you have already decided I will be making a 10% profit or 5% profit. So it is already decided. Rate of return, target return or desired rate of return. That means supplier base and profit on the desired returns investment. And contribution pricing and less than full cost. Contribution pricing is an interesting thing. What is the contribution pricing? That means the supplier is a manufacturing plant and they can see that their direct cost is suppose for example, here it has been written, just read it for the here the price is less than the full cost of the product, but it covers the variable cost. That means the supplier the manufacturer is seeing that they are covering the variable cost and the full cost is not been recovered because of the economic scenario, something bad, it may turn down wrong. So what we are doing, they are just covering the individual variable costs at this moment. So this is a contribution pricing. What are the two categories? The price is not a normal and may raise in the future, and the seller may compromise the standard quality. So it may happen. So here the price is less than full cost, but it covers the variable cost to keep the plant running. It applies for situation to avoid cost of shutting down, right? In many of the scenario, for example, in COVID scenario, many of the production plant had to take this thing. They are only covering the variable cost. They can see that the entire cost is not been covered, but they need to continue the business because they know the good time is coming in. So in those cases, this kind of pricing is done, right? Okay. Okay, guys. Yes, you're with me. Okay, no,
Yes, sir.
what? Okay, fine. Good. The another part is the previous one we have said that cost base, and here the supplier pricing strategy, market driven pricing. What is in a market driven pricing? Price volume. Price volume is one. Here the supplier use cost volume break even analysis to spread the overhead cost and large number. So they used to use the break-even analysis. That means this amount of quantity, if we produce, we will get into a break-even. So if we produce a higher quantity, then we will be exceeding the break-even quantity. So the supplier offers quantity discount for the buyer. So the supplier know that if they can produce if they can produce 1 million units, they will be in a break-even. So they have decided to give a special discount. Anyone offering a anyone is ready to buy more than 1 million product or 1,010,000 product or something like that. That means they are cashing on the price volume. Market share pricing is another thing, that is a penetration pricing. That means just to get into the market, we are giving a lower price to getting into the market, even a free offer. That means buy one get one free kind of thing. Market scheming pricing is another thing. That means setting a high price in the very beginning and then adjusting. What happens in the mobile sections, or if you can see in the technological or high-tech items, in the very beginning, suppose for iPhone, what they do the skimming pricing. Why it is, I'm sorry, just taking a name, but is only for the example, is to put the example, it's not only for the iPhone, it's for any flagship mobile phone that is in the market. For those items, you can see in the very beginning what they do, the product is a fat product. That means it's a very shorter life product. So in the very beginning, what they do, they charge a very high price in the very beginning. In the very beginning, you will get to find the price is very high. When it after getting 6 months or a quarter or 6 months, the price discounted, and within 6 months, the new version is coming in. So market scheming prices are used in those cases. Current revenue pricing is also another method where production item normally in launch, growth, and decline stage. That means in the launching stage, the price is something. In the growth stage, the price is increased. In the decline stage, the price goes down again, right? Promotional pricing, in FMCG product, buy one get one free, or buy two get one free kind of things, or even discounts are there. Market segment pricing is another category where suppliers set different prices. For example, in travel agency, in tourism, you will get to find the hotel rents are high in the peak season and very low in the off season. Competition pricing is just to win the contract, we do a discounting. So that's another thing, right? So assessing supplier cost information. We are a bit late, so just continue for another 10 minutes. I will be closing in, right? Okay. Yes, getting bored.
Yes, sir. Okay.
Okay, great. So assessing suppliers cost information. So open book costing, cost transparency. So let me discuss what it. Open book costing and cost transparency means we are doing the costing in together. That means we are making our cost available to each other. In the open book, the suppliers opening what they have, what are the costs they have incurred in a total, and what are the markup they are doing. So they are making it transparent to us. We see and we agree on, then we buy. And cost transparency is both together make the costing and try to have a best costing solution with a profit added in the last phase. So this is a very good, and what I will say, this is a very good way of working it. In which category it goes? It goes in the strategic costing area. While we can eliminate the operational expenses in the pyramid, if you can recall, if we can eliminate the operational expenses and the managerial expenses in a bit, then we can more focus on doing this kind of things with our suppliers. So we can get benefited, right? Okay, right. Okay. Components of cost base. What are the components of cost base? How the cost is developed? Cost base are developed with raw materials or components, labor, and overhead. That means direct material, direct labor, and overheads. In the overhead, we have production, manufacturing overhead, we have admin and other overhead, we have distribution and logistic overhead as well. So how the cost is developed? We have direct cost, direct material, direct labor, and overhead. We have production overheads. Direct material and direct labor. We have production overhead, indirect material, labor, and expense. Altogether, we have total production cost, that is cost of good manufacturing. And within it, we have our distribution overhead cost to distribute the product, we do have our administration overhead cost added here. So that we have our total cost, which is cost of goods sold. For selling the goods, what is the cost? This is cost of good manufacturing. This is cost of goods sold, right? So how cost calculation can help sourcing and procurement? It can help assess to set parameters for negotiation. If we know cost, we can be a good negotiator. It can help us to compare cost, and it can help us to understand variable cost and assess economic order quantity, minimum order quantity, economy of scale. So these are the things. Total cost of ownership. While we are purchasing something like a asset item or capital expenditure item, we look into the purchasing price only, but the purchasing price doesn't speak anything. Purchasing price is the tip of a iceberg. It doesn't, it is only the 15%. The entire iceberg, it is in the lower shell. That means we see only the acquisition cost. That means in the purchase cost, planning cost, quality cost, tax, and financing cost. But other than that, we do have ownership cost. We do have post-ownership cost. What is the ownership cost? We have downtime cost, risk cost, cycle time cost, conversion cost, non-value added cost, supply chain cost. Post-ownership cost, we have environmental cost, warranty cost, product liability cost, and customer dissatisfaction cost. Just giving you an example. For example, we are buying machineries for our production in our production plant. So it is just for an example. We have a quotation from two of the suppliers. One is the Chinese supplier, one is the European supplier, and we can see the Chinese supplier quoted us $50,000, for example, and the European company quoted us $90,000, right? It's a big difference. So we decided go for if we see that we will be if we take a decision on the basis of the price.
Hello.
Yeah.
Sorry, I didn't understand that the component of cost base. Please, can you state again?
Which one? Which one?
Cost base.
Cost base. The previous one. This one. This one.
No. Back.
Which one? This one?
Yes. Here.
Okay. You want to know it again? Okay, fine. We have how the cost is developed, right? We get to, while we are selling the product, what we do, we have cost of goods sold, right? So we have direct cost. What is the direct cost? The direct material and the direct labor and other expenses. We have production overhead cost, where we have indirect materials, labor, and expenses. All these together, we have total production cost, which is known as cost of good manufacturing. Adding on with cost of good manufacturing, the selling and distribution cost, as well as the administrative overhead cost, we get total cost. That means entire cost, which is cost of goods sold, right? Got it? Yes.
Yes.
Okay, great. Thank you. Thank you for asking.
Thank you.
Good. So let's go again to total cost of ownership. For example, we have two offers from supplier A and supplier B. We have seen that supplier A is this is a capital expenditure, right? The supplier A is talking about the supplier A quoted price of $40,000 for the machine, whereas supplier B is quoted for $70,000 for the machine. So supplier A seems to be very less expensive on the basis of acquisition cost only. That means the purchase cost, planning cost, quality cost, tax, and financing cost, right? But if we see the ownership and post-ownership cost, we can see that downtime cost. Supplier A's product is having downtime after every 2,000 hours, whereas supplier B's product is having a downtime after every 8,000 hours, right? There's a big difference. The risk cost, that means the risk of shutting down is very high, risk of shutting down is low. Cycle time cost, the production cycle time is the output is high, the output is low. The conversion cost per unit is high, per unit is low. Non-value adding cost is very high. That means it's having a longer processing time, it's having a lower processing time. supply chain cost is very high. So these are the costs we have calculated. This can also this need to be calculated as well. Post ownership cost means for supplier A who is having a lower price, is environmental cost is very high. That means it is generating a lot of carbon footprint, and the supplier B's product is more environment friendly. Warranty cost is, that means the warranty of the supplier is for 5 years, and the warranty of supplier B's product is for 10 years. The product liability cost, customer dissatisfaction cost, these are the costs need to be calculated. Only then we will get to find the total cost of ownership. That means that whole right. So cost cannot be calculated on the basis of offer only, right?
Yes, sir.
Cost place, right? Fine. So budgetary control. Let's quickly complete. So what is the budgetary control? So just to show you how a corporate budget is prepared. In the very beginning, to prepare a budget, we need to know what are we going to sell. So we need to have a sales budget. In the very beginning, what we are going to sell throughout the year, we have to plan. So we are going to sell this amount of quantity and this amount of this dollar of this is our sales dollar. So in those sales dollar, we can find our sales budget. On the very basis, if we need to sell this amount, that means, for example, one of the organization is selling cereal, that has already been said, that we want to sell 50,000 ton of cereal this year. So in every month, 12,000 ton of cereal in this year, in 2024. So for example, so every month we are going to sell 1,000 cereal every month, right? That means in 12 years, 12 months is 12,000 ton, right? So if we need to do that, then how much we need to produce? In that case, we need to, if we need to sell 12,000 ton, we need to produce this much. So to produce this much, how much raw material we need to do, how much factory overhead we need to have, how much labor we need to engage, and this is how we find our cost of goods sold budget. And after that, we add on functional budget here. Then we have budget profit and loss and cash budget, which is our budget balance sheet. So this is how the corporate budget is prepared. That means every budget starts from what we would like to sell, that we find out the entire thing. So what are the types of budget? There are several types of budget. One is incremental budget, one is a zero-based budget. Incremental budget talk about what? That means we had a budget previously, we just added the inflation or something like the 2% or 3% add-on, and then we prepared the new budget. So it's an incremental budget. Zero-based budget means we never had a budget, we started a fresh budget, so it's a very new one. Causes of budget variance, why the budget is failed or why there is a variance in budget. The skill of negotiation is very good, we will be having a positive variance in budget. That means we will be under the budget. If the skill of negotiation is bad, we will be having a negative variance in budget. That means more than the budget. Fluctuation of exchange rate. The exchange rate fluctuated and we are an import-based organization, we will be having budget variance. Giving and taking quantity discount. If we have a better discount, having a larger quantity bought in, then we will have a budget discount variance. Sorry, purchase of substitute product in different prices. Right? We were used to buy something as a raw material. Now we have find a better substitute at a better price. We can have a positive budget variance. Increase or late payment price penalties. So, for example, there is a penalty given for the payment, or there is a discount. These are varying the budget in a positive or negative manner. Leveraging costs. So we need to know what are the technique to speed up a cash inflow and to delay a cash outflow. So what are the sources of cash inflow in an organization? The cash inflow, in an organization, revenue or sales, the sales dollar are the main source of cash inflow, right? Yes, no. What is the main source of cash inflow? The revenue, right? What is the main source of cash outflow for an organization? Anyone? Cash outflow. What are the main source of cash outflow? Main reason, main activity. Purchase If you purchase, only then your cash outflows, right, towards your supplier, right? Your main, that means in an organization, you will get to find 60 to 80% spends is procurement spends. So to speed up your cash inflow. So one of the organization need to speed up their cash inflow and slow down their cash outflow to maintain a healthy inflow, healthy cash flow, right? So how to speed up our cash inflow? Make it faster, move it faster, get paid faster. That means if we make the product faster, if we move, that is distribute the product faster and send it towards supplier, customer, and bill them and take their payment, only then the cash inflow gets faster. If we can increase the sale, that means we used to sell 10,000 units, now we are selling 12,000 units, we can have speed up in cash inflow. Reduce customer credit terms. For example, the customer used to pay us after sending invoice 20 days later. Now we have said that you have to pay within 10 days. So this will be in speeding up cash inflow. Encourage prompt payment. If we are saying that we will give you a discount if you pay quicker, then the cash inflow can be faster. What are the techniques for slowing down the cash outflow? Reducing the purchase. If we just reduce our purchase, that's one way. Making more frequent small order. We can buy in a bulk for 6 months. Other than that, we are buying every month. So this is another way of making the cash outflow slower. Hire and leasing. We don't buy rather than buy capital, rather than we are leasing a product or hiring a product. So we are making an installment in every month. So this is another way of slowing down the cash outflow. Negotiation in payment installment. So we have payment installment, we are trying to delay the payment installment. That's another way of slowing down the cash outflow. Delay payment. We had our suppliers paid cash on delivery. Now we are delaying in payment. So that's another way. Extend the credit terms. So we had a supplier agreement to have paid them within 15 days of invoice submission. Now we have turned that into 30 days after payments invoice submission. So another way of dealing the cash flow. So that's all for today. Just what we have seen today, just for a quick thing, then we'll take questions. So in the very beginning, we have spoken what is the sourcing strategy? In the very beginning, we have spoken what is the sourcing strategy, and what setting sourcing strategy is essential to consider. And then we have spoken business benefit for sourcing strategy, the objectives, then link between business objective and sourcing objective. Then if we buy outright, but what are the advantage of purchase and what are the advantage of leasing? What are the disadvantage of purchase? What are the disadvantage of leasing? Then supplier-based relationship, pre-deduction and after deduction. Then we have done a cost-benefit analysis. We also had estimated. We also have done the what is the price and what is the cost. Then we have found what is the primary sources of cost and price, and what are the secondary source of market data and cost and price. What are the external and internal factor for supplier pricing decisions. Then supplier pricing, cost-based pricing, and then supplier pricing, market-driven pricing. Then we had discussed assessing supplier cost information, open book and cost transparency. Then component of cost base, how the cost is constructed, the total cost. Then how cost calculation can help sourcing and procurement function. The total cost of ownership we have discussed. Then budgetary control, we have discussed how the budget is accumulated. And then types of budget, cause of budget variance, and in the final stage, technique to speed up a cash inflow and slow down a cash outflow. That's all from my side. So the floor is open for question answer. So I'm sorry we have taken 20 minutes more than what we were not supposed to be. Anyways.
Hello, sorry.
Yep, good faith.
Okay. Thank you. I would like to congratulate you for a good session that we passed through. But please, how can we get these notes or slide, either through email or advice on the basis? Because we learn, but we can't catch it both of them together. Then we have to review and check where they're necessary.
Yep, I got it. And I'm surely here, Mr. Nazmul from World Academy is here. So World Academy is here. He will be helping you out with this thing. Nazmul, you can have a quick note on this thing if you would like to, how they will be getting it or how you are going to plan for it. Yep.
About what, sir?
In fact, they are asking for how they can get this material. So that is what they are asking.
We'll share with the materials who the participant will join via email, sir.
Okay.
And the certificate also, the attendance certificate also.
Okay. So you get to know that they will be sending you through email at the certification.
When? How can is it possible for today?
No, sir. We'll share probably 2 days later, inshallah.
I think what I would like to request is just the link where we can able to download those lesson in PDF, if it's possible, please.
Yes, sir. We'll share the material, sir. No issue, sir.
Okay, thanks so much.
Okay,
And the session video, please check out our YouTube channel. We'll share the session video there. Hope you'll enjoy.
Okay, great.
Okay.
So your concern regarding the material and the video, I am sure that you are getting it. So no problem with that. So before we ending, I would like to take another. I will ask you whether you have any questions, comments, suggestions, anything from your part that I can take on, or we will be closing it because we are already late by 30 minutes, right? So we need to move on. Yep. Anything, questions, comments, suggestions, anything from your part? Yes, no, what? Nothing. Okay, then, fine. So if it is not, thank you so very much for attending the session. It was wonderful having you. So take care. Bye-bye. Inshallah, we'll take care. We'll be meeting some days in another session. Till then, Allah Hafiz. Assalamu alaikum. Bye. Good night.